Good afternoon and welcome to the Coinbase Institutional Markets Call. It's just past 12 in New York on Tuesday, the 9th of April. We're about 10, 11 days or so from the next BTC halving, so we're going to be discussing that a lot today. We also have a couple of special guests. Joshua Frank, co-founder and CEO of The Tie, will be joining us, as will David Hahn, a research analyst over here at Coinbase, who joined just over a year ago from Goldman. David, welcome to the show. Lovely to have you on.
Hey, Ben. Yeah, thanks for having me on. It's a pleasure to be here.
Yeah, we're really looking forward to having you on the call, and you're going to be joining the next few weeks as well as David. Take David Duong. Sorry, lots of Davids here at Coinbase. David Duong won't be available, but really looking forward to having you on the call. So thank you for joining.
Awesome. Yeah, I'm happy to be here.
Perfect. So we're also going to be covering today. We're 90 days from the launch of the ETF. So what does that mean in terms of RIAs and wealth management having additional asset access to the ETF? We're going to be talking about whether or not it is a retail or institutional driven market and how we can look at some of the most important indicators to try and discern what the answer to that question might be. We'll look at BTC dominance. We're going to take another look at liquid restaking and also some of the large unlocks we've got coming this year. So a ton to cover as always. Now, some quick housekeeping. If you are viewing this via YouTube, please don't forget to scan the QR code to access all of the David's fantastic research, as well as other calls and content that we provide here over at Coinbase. And if you're listening to this on podcast, all of that information will be in the show notes. And no matter where you're listening to us or viewing us, please don't forget to rate us with a 5-star rating. We truly appreciate it. And without further ado, would love to welcome Joshua Frank, co-founder and CEO of The Tie, to the show. Josh, welcome.
Thanks for having me on.
Yeah, excited to have you on. You are probably one of the most connected people in crypto, it seems. You run a company called The Tie. Do you want to kind of give us a quick overview of what The Tie is?
Sure, yeah. So I like to think of us as being the leading information services provider for digital assets. So we operate in a few different areas. Our core is institutional, though. So our core clients are asset managers, banks, OTC desks, market makers, prime brokers, hedge funds, VCs, and others operating within the space. And the core problem that we solve is that information in crypto is siloed across hundreds of different tabs and sources. We're really focused on aggregating everything into a single platform. So we have a platform called the Tie Terminal that serves a few hundred of the largest institutions operating in crypto. We also provide APIs, and then we have a few other pieces of our business as well, including events and corporate access and IR services for token issuers.
Cool, awesome. Well, I will say, full disclosure, I am a user and some of the team are users of The Tie, and we do find it a very useful platform. But anyway, I guess one of the things that we use it for is to try and understand what's going on in the market and some of the trends. We have the Bitcoin halving coming up shortly in and around April 20th. I'm curious, like, you've been in the space a long time now, you've seen multiple halvings. Like, how impactful is this halving, do you think, vis-a-vis some of the ones in the past, especially given the market structure has evolved significantly since the last halving and especially over the last 3 to 6 months?
Yeah, look, I think the original halvings were super meaningful when you went from 50 Bitcoin to 25 Bitcoin, right? Per block. That's a lot more impactful than, the drop that we're going to have now, reducing the supply by about 3 Bitcoin per block, right? And so I think at this point that, if you look at the total amount of ETF flows and one of your other guests, David, who will be on, mentioned, I think earlier, the fact that, some individual firms have more Bitcoin than the total amount of Bitcoin that are going to be mined next year. I think from that perspective, the halving is, a relative non-event. However, it's crypto, and crypto is narrative driven. When we see that from all of the meme coins and things like that. If you actually go to slide 7, which is really interesting, we created a chart of the number of halving mentions in the news over time. And you can see that it's really starting to ramp up. We can see the last halving was around May 2020. And so you can see that giant spike. And you can see it even looks like we're seeing more mentions. And this is across crypto native publications, mainstream media, and things like that. We're seeing more news around the halving now. It's starting to pick up. And so the halving is an event in that people think it's an event, right? And that's the same thing with crypto, right? The reason a meme coin goes up is because somebody thinks it's going to go up. And so I think it's important to note in that regard. But I think the market, and I'm curious for others' opinions, is going to be driven primarily by ETF flows, by macro, and by other things coming in. But the fact that this is a narrative and people are going to talk about it, I think is also going to have some level of impact.
I guess what's interesting in that chart there is we're still quite a long way off the highs with regards to dimensions, and I guess we're 10, 11 days out, so we've still got a bit of time to get there. But
that is daily data, though, so it looks like there was only about one day where the mentions were that high. It was probably the day the halving actually happened.
Yeah, I guess we can look in when the halving does happen and see how we compare, because one would assume that number should be much higher this time around, given the maturity of the asset class and the space in general. David, we'd love to bring you in here. I'm curious, how do you think about this? Would you broadly agree, or do you think it's something that's still very, very meaningful?
I'm very in line with Josh here. I think the halving is a very big narrative. It's almost a self-fulfilling prophecy where people think, hey, the halving is going to reduce issuance. There's going to be a supply side squeeze, and then the price is going to go up. I think that's kind of played out in previous cycles, and people expect that to kind of continue on. I think there's always a question of how long that will continue on. I think there's a little bit of significance here. If you look at the halving, that's going to reduce the amount of new Bitcoin issued by around $30 million a day at 144 blocks per day. If you reduce the halving or reduce issuance by 3.125 Bitcoin per block at $70,000 a price, that's around $30 million of reduced sell pressure per day. But in the grand scheme of things, like Josh said, there's a lot of holders who just hold way more Bitcoin than is going to be produced all of next year. And I think their impacts are going to have way more, or their movements are going to have way more impact into the market. One other thing I think that's a little bit different here too is that we've hit all-time highs before the halving, which has not really happened historically. Usually meaning the last 2 or 3 cycles, we've hit the halving or all-time high prices around 6 to 9 months after the halving. So there's some different structural flows here compared to what we saw in 2020 and in 2016.
Yeah, again, kind of back to the ETFs, as Josh mentioned at the start, like that's such a game-changing part of the industry now, which wasn't around in the past. Greg, would love to bring you in here. Like in terms of like from a trading perspective, like are we seeing people position ahead of it? Has that already happened? Like, is an important thing from a trading perspective? Do you feel?
I think it will be, again, just because what's already been mentioned, the power of the narrative here. But we're getting pretty close to when this, what is it, April 19th, April 20th, is sort of the target date right now. And it's really not coming up in client conversations as much as you'd expect it to, especially being this close. So that leads me to believe, if it is going to have a positive impact on price, a lot of that isn't priced in at the moment.
So a question to everybody, like when does that narrative stop? I guess we're 4 and a bit years out to the next halving roughly. Is it relevant then, or do we feel like the space will have evolved significantly whereby it's really not relevant? Josh, maybe let's start with you.
Well, I think the thing to note is that crypto is not it's not one thing. There are lots of different subsects than crypto. And like, if you've ever gone deep on like Bitcoin Twitter versus like crypto Twitter overall, I think the halving is a bigger narrative, especially among, Bitcoiners. And, you can see Bitcoin conferences have, tens of thousands of people showing up, and you have, you have guys that are just big proponents of Bitcoin itself. And so I think, that community is always going to talk about the halving. But I think in terms of broadly, having conversations, right, if we're saying that, now it's going down to 30 million new Bitcoin per day, the next halving, it's going to be 15, then it's going to be 7. I mean, at some point it's inconsequential. I mean, I think I looked earlier today, I think Bitcoin is about $1.36 trillion market cap. So, I mean, it shouldn't be that consequential now. It's a little, going from 60 to 30 it's meaningful. I mean, it adds up, right? You're talking, weekly $210 million left of selling pressure. If you said there was a new hedge fund being set up every single week to buy $210 million of the Bitcoin, you'd be pretty excited about that, right? And so I do think in that regard, it's kind of consequential, but I have to imagine, after this one, I still think this one is significantly less meaningful than the last one, and that's significantly less meaningful than the one before it. But I think once you get past this one, it really, you start talking about, amounts of dollars that are traded every minute in this space.
Yeah, and I guess one of the charts that I would love to kind of run through is like Bitcoin dominance as well. That's been kind of trading up recently post ETF. Greg, would love your perspective here. Let's bring up the BTC dominance chart now. How do you feel like that's going to evolve post halving? Do we see that come back, or or kind of strengthen further, do you think?
Yeah, I mean, Bitcoin dominance is kind of an interesting topic to think about, because generally in this part of the cycle, you'd expect it to start to fall as, you know, some of the altcoins get bid up. I think this time it could be different, because Bitcoin is the sole asset at this point that has access to a much broader pool of capital than, you know, ETH and the other altcoins. So it wouldn't surprise me if, you know, we see money continue to come into Bitcoin and that dominance rise. Now, a few things that could keep a lid on that or the one thing that we're keeping an eye on, at least, is you know, token launches. As new tokens are launched, you know, that does suppress Bitcoin dominance. And, you know, crypto, we're constantly launching new tokens and new projects are being born. So, you know, that's another thing just to keep an eye on.
Yeah, Josh, curious for your thoughts. We've got April 10th is an important date where a lot of the RIAs and wealth management platforms have had their 90 days from the launch of the ETF on January 11th. That, in theory, should bring a lot of new capital in, which, if it activates, should also keep BTC dominance high. How do you think that's going to play out?
Yeah, look, I think there's a lot of reasons for Bitcoin dominance to grow. I think in terms of substance versus narrative, substantively, or whatever the word is, you know, there are reasons for Bitcoin. There's reasons for Bitcoin to grow, right? You have the ETF. You know, a lot of the initial ETF flows, from my conversations with the largest issuers, they believe those flows have been retail driven, because it takes a while for institutions to really start allocating, to get comfortable allocating client funds and others to the ETF. So I think from a substance perspective, there's a lot of reasons for the ETF or for dominance to continue to grow. But I think, to the point that Greg made earlier, there's a huge number of TGEs and there's a huge number of unlocks. And, you know, you're seeing some tokens out there in the market now that only have a couple of % of their supply unlocked. As that supply unlocks, you know, you're talking, there are tokens that are 15, 20, 70 billion FDV, right? Those unlocks are going to happen. That supply is going to come to market, and that probably is going to suppress dominance. But you also have some, you know, what I would define as bull market activity with, you know, meme coin mania and other things going on that I think we all believe at some point will cool itself off and will regress, and that should also push dominance up a little bit as well.
Yeah, and here was me thinking that all of these meme coins were kind of strong fundamental bets on the on their longer term progress. It depends.
Some of them, you know, maybe. You know, if you read crypto Twitter, you really would think people fundamentally believe in some of these things.
I think fundamentally some people do, which, you know, that's there's a passion there. I think what's interesting is, well, some of these platforms, as you mentioned, like we probably got a couple of, like Carson and Cetera, we know are already live. That's about $300 billion of assets. We know Morgan Stanley and UBS are live, but in a limited way in terms of reversing query or min balance restrictions. So we know there's a lot of those people are active, but we also know that it takes time for RIAs to be educated and start thinking about this as a part of their portfolio. So definitely still got some runway there. Now, Josh, another part of your platform which is helpful is kind of seeing filings from the SEC or various others, including 13F filings on May 15th. Do you feel like they're going to be important to see who's actually kind of buying these ETFs as some of these public funds report?
100%. I mean, right now it's kind of guessing, right? For lack of, you know, I mean, it's guessing, right? Like I have conversations with a lot of the big ETF issuers, and they tell me they believe it's retail. But it would be really interesting to see in 13F filings, when funds are required to report their holdings, to see who exactly is holding these things, who is buying them, you know, how many firms are buying them, or what percentage of their AUM these firms are buying at, you know, like which products they're buying. Are they buying the same products as retail? Are they buying different products? What percentage of the holdings are institutional is going to be an interesting thing as well. And I think it's interesting in May, but I think it's going to become more interesting over time as we see those change in holdings, because what we want to see in the narrative that's being pushed is that people should have, you know, 1% or 2% of their exposure to Bitcoin is a narrative that I think a lot of people have been pushing. And so to see, are these institutions really growing to the point where we're getting to 1% or 2% of their assets under management being Bitcoin and how that relates to gold. Are they selling off gold to buy Bitcoin? Are they buying both? I think that's also an interesting thing to take a look at.
And when we think about filings, Josh, we'd love to hear your thoughts on Form D filings. Like, as we think about new capital moving into the space, it comes in a number of ways, whether it's ETFs or directly into venture funds. Maybe can you start with like a description of what a Form D filing is and maybe what we can learn by keeping an eye on those?
Yeah, so Form D and DA filings are filings that U.S. reporting funds have to report, where they basically report the amount of AUM or the amount of assets that they've raised and the number of investors that they've raised from, and a couple of other metrics. And so in the last cycle, we saw a massive amount of capital raised by firms like Andreessen, Han Ventures, Paradigm, Multicoin, and a bunch of others, right? Where they've raised, in some cases, hundreds of millions, in other cases, billions of dollars in new capital. And one thing that's going to be really interesting to see is, I believe that right now, the majority of the movement that's happened in this market has been driven by crypto natives outside of Bitcoin, right? I think Bitcoin is being driven by a broader audience, which is great. And we'll see a lot of that in the 13F filings. But I think, a huge amount of what's happening right now in like the L1, L2 space is being driven by crypto native funds. From a venture perspective, though, those funds are going to need to raise more capital. And the question is, are they going to be able to raise more capital? I think they should be able to raise more capital. But remember that a large number of pensions and endowments and others that allocated to the space really got burned in the last cycle. There's a lot of them that invested in FTX, that invested in Celsius, that invested in BlockFi, and some of these other companies. And when you are a sovereign wealth fund, for example, and you're reporting to the citizens of your country, or you're a pension that's representing firefighters or teachers and things like that, right? You have to justify the investments that you're making. And so what's going to be interesting to see is, are these funds going to be able to raise a large amount of new capital? I think from a track record perspective, there are a lot of funds that invested in Say, that invested in Eigenlayer, that invested in, some of these new projects, WorldCoin, that are starting to emerge at Celestia, at giant market caps and giant FTVs, even Pith and Wormhole and others, right? And they're going to look great, right, in terms of the returns that they give to their investors, at least on paper. We have to obviously see, a lot of those tokens aren't unlocked yet. So we have to see, as those unlock events occur, whether or not tokens retain those prices and what their real return on invested capital is. But I think it's interesting to watch. And the reason I think it's important is, we haven't yet seen in Form and DAs a huge amount of new capital be raised by U.S. reporting funds. But with that said, the way that Form Ds work, they're really for new funds. And then DAs, there's an annual amendment when you talk about the amount of new capital you raised versus your last DA or your last D filing. So because they're annual, it can slightly lag the market. But with that said, I don't think we've yet seen a ton of new capital come in. And that new capital is going to need to come in if we want to continue to see the altcoin market be propped up and funding that's coming into the space be propped up.
And in terms of venture raises, you mentioned a few there, certainly those that have had TGEs, token generation events, and have very, very large FDVs. We have seen some good venture raises recently. Monad, Berachain, Eclipse to mention just a few. How do you think about those raises? Is it in a particular part of the market? Obviously, AI has been a pretty hot narrative. What other parts of the market are we seeing lots of venture capital going into, or crypto funds investing into, and why do you think?
I mean, I think it's tokens, not equities, right? If you look at the equity space, there are a number of companies that raised at very large valuations in the last cycle. I don't need to name them, but companies that raised at, $2, $4, $6, $8 billion valuations. I think it's going to be really hard for those firms to have a liquidity event. I think it's really going to be, I don't think those firms are yet mature enough and ready to go public. In some cases, they raise at 100, 150 times revenue. On the other hand, you look at all these token deals, and I mentioned a few, right? Investors in some of these projects, people got into WorldCoin at a couple $100 million. That thing was up to $100 billion FDV. So the returns that investors are getting is pretty astronomical. And where the majority of funding is going to come into is L1s and L2s, because that's how you invest in scale. And if you look at these really big funds that raise capital, right, your Paradigms and your Andreessens and others of the world, if you've raised a $3 billion fund, the only way to put it to work at scale is really on like the L1, L2 side of the market, and maybe some other applications and coins. But I think you're going to continue to see that because it's a way to get into the market at scale and then actually get liquidity and get out of your position, which we just haven't seen in the equity market yet.
Makes a ton of sense. David, we'd love to bring you in here and kind of, I know you've been doing a lot of work on Solana and Congestion, and to Josh's point, like you've got a lot of investment going into L1s and L2s. L2s have kind of been competing with Solana in some ways, or maybe competing is the wrong way of framing it. We're all kind of trying to grow the pie, but Solana has been seeing some congestion recently. I'm curious for your thoughts on that.
Yeah, sure. I mean, I'll talk about Solana Congestion, and I can talk about L1s, L2s, and that whole scalability roadmap. Solana Congestion, I guess there's two parts. One hand, there's transaction failure rate. That's kind of parroted a lot. The other one is transactions that are being dropped. Now, one thing that's a little bit unclear in this space is there's a lot of very clear data on transaction failure rate, and a lot of people use that to assume that, Solana has 75% failing transactions, therefore 75% of all transactions failed. I think that's kind of a misnomer. The thing that people should be aware of but are not able to look at is the transaction dropping rate. So that's when you submit a transaction and it doesn't even land on the blockchain. That means there's no data, it just disappears. So one big difference between Solana and something like Ethereum is that Solana has no mempool. In other words, when you submit a transaction to the Solana blockchain, there's no centralized data store where you can see all the pending transactions. And in Solana, what happens is your transactions are submitted to the block leader, so whoever can create the next block, again and again until your transaction expires. This is also a unique thing to Solana, where your transactions will actually expire if they're not put into the blockchain within a certain amount of time. So this is probably what's impacting most people today. The failure rate has actually remained roughly equivalent over the last month, from 60 to 70%, so it hasn't really changed very much. But the dropping rate has definitely spiked up. We don't have very clear stats on that, and you can't really get very clear stats on that unless you run a Solana node yourself and you can figure out your own dropping rate. So there's a lot of non-transparent metrics here that are at play. But overall, I think there is some congestion here. I think that will be somewhat alleviated on April 15th when they start to roll out their 1.18 fix. They're going to have the full upgrade on April 22nd to upgrade all the nodes to 1.18. But in general, this is something that Solana is working on. It's not a fundamental consensus issue. It's more of an engineering problem. And there are ways to kind of resolve this with higher fees, better scheduling, etc.
So David, the 1.18 fix, is that something that was always on the roadmap, or is that in response to this current cycle? There's been a ton of meme coins on Solana and obviously now failed transactions. Was that already planned, or is that in response?
Yeah, 1.18 has been in the works since at least early December when I started tracking it. What they're planning to do essentially is to improve the scheduling of Solana transactions. So right now, Solana is, you hear a lot about parallelization, multi-transaction processing, but it's very random. So when a block leader receives multiple transactions, there's no real priority mechanism. So you can't figure out which transaction should land, which transactions should be deprioritized. And so 1.18 should help alleviate some of this stuff. And this stuff has been ongoing in the works for several months. And there are other things that can help with the current congestion as well that will probably be introduced in future upgrades. So 1.18, I want to make it clear, is going to help alleviate some of the issue. It won't really alleviate all of the incoming issues. There still might be some congestion, but it'll definitely be alleviated somewhat.
So post that, would we expect to see a failure rate dropping to sort of sub 50, sub 20? I mean, obviously very tough for you to estimate, but we would expect that to drop in general?
Possibly. I think one of the tricky things about the failure rate is that the failure rate is generally created by bots. So because transactions are so cheap in Solana, even compared to some L2s, there's like a flat fee of maybe 1/10 of a cent. People want to spam the transactions to get onto the chain because there's no prioritization mechanism. So you're incentivized to say, instead of paying a higher fee to get one transaction in the blockchain, you're incentivized to send 100 transactions doing the same thing. And so you have a huge botting problem right now, and that's kind of what's causing this high failure rate. If 1.18 can reduce the number of bots and spam, then I would certainly expect to see the failure rate drop significantly.
Perfect. And then perhaps can we just contrast that versus kind of base and other L2s? We've been talking about those a lot over the last few weeks, and we'd love to kind of touch on Farcaster in a second, and Josh, get your thoughts on that. But how do we kind of compare and contrast those two structures at the moment and how they're performing?
Yeah, I think on Solana versus L2 specifically, or EVM L2s, I would say from a user perspective, so not even technical perspective, the biggest difference is in Solana, the fees will stay cheap, and they have been cheap, even if the network gets congested. But the trade-off here is that as a network gets congested, it's harder and harder to land a transaction. On the other hand, with something like Base or some of the other L2s, if the network gets congested, your fees will go up and they will spike. I think we saw this recently with Base fees spiking somewhat, but you're at the same time, you're able to land a transaction if you're willing to pay the fee. So you're guaranteed to be able to land a transaction, but you have to pay a higher price versus you're not guaranteed to land a transaction, but fees stay low. So there's two different trade-offs from the user perspective. And I think the way I view it is this is the primary trade-off, not technical trade-off, but just from a end user perspective, user experience trade-off that we have between L2s and Solana.
Interesting. Josh, curious your thoughts. You've been playing around with memes on both Solana and Base and others?
I personally have. It's funny, actually. A lot of our very institutional clients have asked us to build meme data. We know it's definitely for their PA and not necessarily for their fund. So I haven't spent all that much time. I know that the second I start spending time, it's going to be the end. It's going to be the top, and I'm just going to lose all my money. So I've stayed away.
Interesting. How about Farcaster? Is that anything? Actually, I guess maybe another question is what else are your institutional clients asking for? Like what? So meme data. Again, perhaps not for the main fund, but what are some of the other things that a common request that you get?
A lot of derivatives. I think the demand for crypto derivatives is through the roof now, and I'm sure you guys are seeing that as well on your desk. I think people are continuing to monitor the ETF. I think there's a lot more requests for Bitcoin data. It's a big mix. Honestly, everyone's different, and it depends if it's a crypto native or a traditional institution. From a traditional perspective, really the only interest we see is Bitcoin and Ethereum and maybe Solana and a couple of other assets, but it's primarily Bitcoin and then a little bit of Ethereum. In terms of crypto native funds, I think they're starting to go down the rabbit hole and get a lot more, going down the risk curve a lot more and going to that longer tail of assets. So a lot of the requests that we're getting is, I think it's been interesting to see one of the big trading firms actually sends us an email every week of the number of assets that are listed on other exchanges and just seeing how much that's spiking. And we're even hearing that from the market makers and others, just demand for coverage of like this really long tail of assets. So I think honestly, from crypto native firms, it's just really long tail coverage of assets. And I think even looking at, I think there's just a demand to see all the new things that are emerging and happening on chain. Versus from a traditional institutional perspective, it's really just Bitcoin at this point.
Interesting. So almost it breaks down between what they'll trade versus what they want to be researching and understanding, so that when it is at the right point of its maturity, they can jump in with all the right data around it and make educated decisions. Is that
look,
fair?
I think and crypto natives are also, I think they're just going much further down the risk curve again. I think that just happens in bull markets, right? Where, firms are starting to, we're hearing firms that weren't market making DeFi now starting to market make DeFi, doing more things on chain, doing more things across chain. I think there's also a big demand for cross chain data and analytics and understanding user flows across chains and things like that. And I think a lot of people now also just want to care a lot about social related data, because we're at a point in the cycle right now where a lot of things are being driven and have always been driven in crypto by social activity, by sentiment and things like that. And so I think there's a lot of demand there on just what are people talking about? What do people care about? What does retail care about? And what are kind of the trends we're seeing in the market?
Yeah, that makes a ton of sense. I guess looking at some of the newer protocols that are coming on chain, whether it's Ethena or it's EigenLayer or Puffer, restaking perhaps as an example, is that an area where there's good dashboards that you can kind of see those TVLs growing and something that institutions are interested in?
I would say we haven't had that much demand on restaking yet. But we also don't service that many VC clients. Our clients tend to be more traders, so more like hedge funds and others. But I think that will pick up. What we see is it's very, very, very slowly, and then it's all at once, right? It's slowly, and then like second something hits, like people are going to really want a halving dashboard for a week, and then after that week, they're not going to care anymore. And so you kind of have to react in real time to client demand and just come up with things on the spot. Like we launched our Bitcoin ETF dashboard the night before the ETF launched, right? And that was great, but like now a lot less people are looking at that today than looked at that. It went from our number one most popular dashboard last month to probably 10 this month, right? And so now memes this month is the most popular thing that people are looking at. So it just it depends on the week.
Got it. And David, we mentioned restaking there. We'd love to bring you in here. I know that's an area where you have been doing some work. How are you thinking about the restaking space right now?
Yeah. Well, first off, I think restaking is a game changer for Ethereum. It has the second highest TVL of any protocol across all of crypto, second only to staking itself, even before going live with any AVSs or actively validated services. So pretty much what restaking will actually bring to life. And it's gotten there faster than Lido has gotten their market share in terms of staking. So their TVL has been growing really fast. There's a lot of interest in terms of restaking tokens, so liquid restaking tokens, kind of like what we have with liquid staking tokens, but on top of EigenLayer instead. So you're seeing a lot of demand there. One thing that you see is I think on EigenLayer, around 60% of their entire TVL is done via secondary protocols. That includes Kelp, Puffer, EtherFi, and many other things. And they're also very, very diverse in terms of the breakdown. So whereas there are a few major players in the liquid staking space, there are a big diverse pool of restaking tokens. This could pose some issues in terms of collateralization, usage in DeFi, liquidity fragmentation, but also this competition I think will net be a good thing in the long term. I think what does concern me a little bit though is I guess the short-term excitement around this and some of the valuations that we're seeing in terms of how much expected yield there might be from restaking. Given that the first AVS to go live will just be EigenDA, we don't think that the improvement to your native ETH staking yield will be very meaningful, at least for our first few months. So just to run a ballpark number on this, if you assume that all the fees paid to Ethereum blob storage, EIP 4844, is actually put onto EigenDA, you're actually only going to get around a 0.1% additional yield on top of whatever staking yield you get. So say if it's 3%, 3.2% today, then it might become 3.3%. Now, as you get more and more AVSs, if you have 10 AVSs, 20 AVSs all giving you this, that becomes a meaningful amount. But that takes at least several months, if not years, to get there. So we think that there might be some missed expectations in terms of additional yield that restaking will give you in the short term, at least for the first month or two after launch, before any other AVSs go live.
Interesting. So I guess what we heard there is that the returns may not be quite as high as advertised, but it doesn't sound like you're concerned about kind of contagion risk or kind of additional forms of leverage entering into the ecosystem. Is that fair?
I think in the short term, I'm not as concerned about it. I'll be a bit more concerned when you see more and more of these LRTs, so these liquid restaking tokens, being used as collateral, and you start to see more and more looping strategies. Today, you don't really see that much LRT usage as collateral in this space. I know, I think it was around 2 years ago when staked ETH, liquid staked ETH and ETH depegged, there were some issues when it was used as collateral, but you don't really see that as much in the LRT space yet.
And for our viewers, do you mind just defining LRTs?
Yeah, so LRTs and LSTs. LRTs are liquid restaking tokens. So it allows you to tokenize a position in EigenLayer or any other restaking protocol. And liquid staking tokens are stuff like CBETH or STETH, which allows you to take a liquid token position in terms of staked ETH. So it just allows you to take your position, earn yield on it, and use it as collateral or in other places in the DeFi ecosystem.
Perfect. Awesome. Thanks, David. Yeah, one to keep an eye on for sure. I mean, the growth of that TVL for EigenLayer specifically has been quite impressive. I mean, also the same can be said for Ethena. The growth there has been very, very quick. And I guess they both share attributes in that you can utilize it for collateral and juice the yield that you're getting by doing so. And as we all know in crypto, having all been through a few cycles, if people can loop and they can leverage up, they generally will do. But timing is always key. Now, just going back to something we mentioned earlier on around large unlocks coming and some of the returns. Now, Josh, you mentioned there's some VCs that have made some super smart investments and are sitting on some sizable gains here. But there's also going to be some large unlocks which might make some changes around BTC dominance. What can we be expecting, Josh, in that space in the coming months, maybe through to the end of the year?
Yeah, if you pull up slide 9 in the deck. So this is just a chart that I quickly put together. These are this is US dollar amounts. So the number on the side is US dollar amounts. So we're expecting upwards of about $80 billion worth of unlocks between now and the rest of the year. And if you look at the market cap of crypto overall right now, it's sitting about 2.6 trillion. So it is a very large amount of unlocks that will be happening relative to the overall market cap. Like a couple % of crypto is now going to be unlocking. So I think it's it's super meaningful. You can see there was large unlocks that occurred in March. There will again be some really large unlocks that are occurring in April. But within this number is, tokens that are seeing hundreds of millions, if not billions of dollars in unlocks individually this year. And so I think that's something that we definitely need to keep an eye out. A lot of these assets that investors, at least early on, have really large returns in, right? The question is, well, are they going to be able to realize those returns as the unlocks occur? I think a prominent example of that is WorldsCoin, where on WorldsCoin the FDV right now is sitting at about $70 billion. Only about $1 billion of that is liquid. So you're talking in the range of about 1/65th or 1/60th or something of the WorldsCoin supply is currently liquid, right? As more and more of that becomes liquid, as investors unlock, and WorldsCoin is just one example, and I'm not trying to pick on it, right? But as you see these assets have large unlocks, the question is, do investors actually, are they able to get their money in? And to the point you made, what does that do to Bitcoin dominance, right? If these assets maintain their prices, that means Bitcoin dominance, all things equal, is going to decrease as the new supply of these assets is significantly higher than the new supply of Bitcoin.
Greg, what's your perspective from a trading view? Because we've seen a couple of unlocks, as Josh mentioned earlier this month, and how have they traded? How have people, clients, investors thought about those into them as well?
Yeah, so the crypto native funds, as Josh mentioned, are very active trading around tokens that have these unlocks. It's for the tokens that are unlocking, and investors really like the projects, and that's most of the ones we've come across. We're actually not seeing a ton of sell pressure. However, interested buyers have to be very careful because the cost basis of everyone or a lot of the folks that are being unlocked is so low that if these tokens do end up trading down, these sellers become rather price agnostic. And a way to think about that is, if you imagine a token's trading at $2. And it starts trading down to $1.80. If your cost basis is just a couple pennies, you're really not that price sensitive. Whether you're selling at $2 or $1.80 or $1.70, as that starts to go lower, you just start hitting bids. And I think buyers are aware of that, and it's keeping them on their toes, and they're being relatively passive. Again, regardless of what they may think the prospects for that particular project are.
And I think it's super important to note DPI, right? DPI is such an important metric to venture funds, and the fact that these funds want to be able to raise capital again. And if you're sitting on a position, to your point earlier, Greg, that you got into for a couple cents and is now at a couple dollars, right? You want to be able to earn your performance fee, right? You're not earning your performance fee yet. You want to be able to earn your performance fee on those assets, and you want to be able to return that capital so you can go and you can raise additional capital in the future. I think one thing to keep an eye out, though, is, are assets going to be returned in cash, or are they going to be returned in kind? I think some funds are going to have such large positions in certain assets that are just not liquid enough that I think they're going to, and there were a couple of funds that did this in the last cycle. I'm not sure. I think some of it is public. And I'm curious as to, if you're sitting on $1 billion worth of one of these new L1s, are you just going to return that $1 billion in that token to your investors? I don't know. I spoke to a big fund in this space, one of the 5 largest funds, that said they already have 2 positions. They're planning on doing that because they're just going to move the market too much if they start selling.
Interesting. And just for those that aren't aware, DPI stands for distributions to paid in capital. So essentially how much you're giving back to your investors versus what they paid in. I guess it's a tough one though, right? Because if you're distributing an illiquid asset, is that a real return? Because the investor has to go and they have to try and trade out of it themselves, and that's probably not their expertise. And they probably went into the fund in order to take away some of that hassle. But maybe the returns make up for that.
Yeah, it's a real. And what do you take a performance fee on in that token? I don't know. It's a difficult thing to think about, but I do think it's a real thing, and I think it will happen. Yeah.
Yeah, I mean, I think this is the perfect time to say this is where Greg helps you out. So if you need any help on that, that's exactly where Greg jumps in and tells you exactly how to trade it and gets you out in a good way. Sorry, couldn't avoid the Coinbase plug. Josh, you were saying?
No, I mean, I'm all for the plug. No, I mean, I was just saying, look, I think it's going to happen. It's real. There's going to be massive unlocks. And, I was speaking to, a fund the other day. They raised $200 million. They're sitting on in one of their positions of a token that's not unlocked yet, 2 yards, right? $2 billion. So that fund is going to 10x from the return of a single position they have in it. And there's a couple of funds like that, maybe not at that scale, but that put 25, 10, $15 million into something earlier stage. They're now sitting on the books of what is theoretically, if you take the FDV as a real number, $500 million, $300 million, $1 billion position that has the opportunity to single-handedly return the entire fund, right? And so, they're going to want to either sell those assets or distribute those assets in kind. I mean, I think you'd be irresponsible to just hold on to them and kind of, kind of put your finger, in the wind and be like, I don't know, whatever's going to happen. Or maybe I'm sure the guys at Coinbase here are happy to help you hedge out of some of those positions as well. I think, hedging out of some of these positions going into unlocks, I think is also going to be something that's really important for firms as well. And I think there's other firms that are willing to buy locked tokens. I think that's also going to be an interesting, opportunity. I've had some of my clients say, hey, who has a position in, X or Y token that's unlocking over the next 24 months? I'll buy it off of them at a discount. So I think, some sophisticated funds that, know how to hedge their risk are going to start doing that too.
Yeah, that's right. I mean, we saw a lot of that around the Sol tokens, which was very public in the last couple of weeks. So yeah, I expect to see more and more of that. Greg, in terms of, I guess, flows, just like a general overview, what have we been seeing on the desk? And we've spoken about ETFs and their continued importance. How are we shaping up there?
Yeah, it's flows generally are quieting down some. Bitcoin specifically has been rather range bound between, call it, 62 and 72,000. The ETF flows, those are obviously public. Those have slowed down some as well. It'll be interesting to see if the halving, when we get there, is the narrative that we think it could be that powers us higher. But it continues to be a tale of two markets. We have those that are focused on Bitcoin and those that are focused on everything else. All these altcoins, whether they're projects that are unlocking or new narratives hitting the market. So we really kind of seem to be in a bit of a holding pattern here. And one thing to keep an eye on is we are going into a seasonally tough period for risk assets. So I think if we can kind of even just hold these levels for the next, few months, I think that'll be a really good sign for our market.
And Greg, I know you keep a close eye on basis. What's been going on there in both ETH and BTC? Yeah,
so they, along with our market, the spot prices have calmed down. Right now, you have just have it on this screen over here. Both ETH and BTC basis about 10-11%. Earlier this week, over the weekend even, we saw perp funding rates, so sort of a different type of basis, and one that's more crypto native. They had come down from a few weeks ago. We were talking about how we saw rates for BTC and ETH as high as 50, 60, even 70%. They had come all the way down to 12, 15%. So relatively low. We've seen them trade up again, which is indicative of more longs coming into the market. Now we're at about call it 20% for perp funding levels, which is I think reasonable given where we are. So nothing in either the term futures or the perp basis looks stretched one way or the other at this point.
And Greg, Ethena, I think we spoke about it briefly last week. It's added in about another $600-700 million of TVL this week. I know you've had a few conversations with some clients. I'm curious, how are people thinking about it? It feels like there's kind of two sides. Like some are concerned, some aren't concerned. What are you generally hearing from some of our clients?
Yeah, so it is coming up a lot in conversation. I think the general view is it's a really interesting product, and that's what it is. It's a structured product, is what we're hearing, rather than a synthetic dollar or a stable coin. And what that means is that structured product, could potentially give you upside, but there are also, various scenarios where that's going to incur losses. Those scenarios could be what we've talked about in the past, persistently negative funding rates, some sort of counterparty event, or just, everybody rushing to the exits at the same time. But nevertheless, it's definitely an interesting product, and I think as it more capital, it'll be something to watch. Is what it does to funding rates and the price of leverage, on these perp markets.
Yeah, that makes a ton of sense. Well, thank you very much for that rundown. Also, thank you, Josh, and for joining us today, and thank you, David, for his fantastic first podcast with us. And we'll be seeing a lot more of him as well, which is great. And thank you all for listening in. Take care. Good luck out there and have a great week.